Starbucks just reported record sales and the stock price barely moved. At the latest price, the company now has a market cap of $115 billion. It's got $4.3 billion of cash and investments and $13.5 billion of debt, so the enterprise value is $125 billion. Revenue in the latest quarter was a record $9.2 billion, which means the company has produced $35 billion of revenue over the last 12 months, $3.8 billion of net income, and $2.9 billion of free cash flow. Based on these numbers, Starbucks stock is now valued at 3.6 times revenue, 30 times earnings, and 43 times free cash flow. And the stock also pays a dividend of 2.1%. 30 times earnings might seem expensive, but Starbucks has been a reliable performer. Revenue has grown at roughly 9% per year over the last 10 years, with earnings per share increasing by roughly 12% a year. That said, net income is yet to regain its 2019 peak, and gross margins have fallen from almost 30% in 2017 to 27% today. With a market cap of $125 billion and over 37,000 stores worldwide, it's understandable to wonder how much more Starbucks can grow. But the company has at least 4 options for growth. 1. Despite already having 16,000 stores in the US, Starbucks still has room to open new stores in smaller cities, as well as smaller format stores in bigger cities. 2. Starbucks has plenty of room to expand in international markets. The Chinese segment reported exceptional growth this quarter, with revenue up 51% year over year. As noted by QSR, the company's ambitious plans equate to a new store opening in China every 15 hours. 3. Even without store openings, Starbucks can improve earnings by introducing new product lines and increasing prices. Cold beverages and snacks have been key revenue drivers in recent years. 4. Even without introducing new products, Starbucks can use its cash flow to buy back shares. In February, the company reinstated its buyback plan, penciling in $20 billion of buybacks through 2025. And in a recent presentation, Starbucks said it expects to deliver 7 to 9% annual revenue growth and 15 to 20% earnings growth over the next few years. If you assume that Starbucks can grow earnings 15% a year for the next 5 years, and then it trades at a 25 times multiple, the share price would be worth $167 in 5 years' time. Include dividends and the annualized return works out to just over 12% a year. All that said, there are some risks to owning Starbucks, and one of the biggest may be its brand. The company has had issues with labor unions in the past, and it's only natural that as a company gets bigger and more diversified, it loses some of its brand power. Rival Dutch Bros is tiny compared to Starbucks, but it's growing fast and has plans to scale to 1,000 stores by 2025. Overall, Starbucks is unlikely to achieve huge growth in the US, and so a lot comes down to China. The company seems to be doing well over there, so I think the stock should continue to provide decent returns. That's why I give it a bullish rating, but these are my personal opinions, not financial advice, and I hold no position in the company. For more detailed investing ideas, make sure to visit our website, overlookedalpha.com.